Welcome to the technical analysis webinar here with AvaTrade. My name is Troy. I'll be leading the session. As we get started, let's do a quick systems check. If you would, type OK in the chat box if you're hearing me clearly and seeing my screen all right. Just waiting on a few more replies to make sure we're up and running fine for everybody. If you would, type OK in the chat box if you're seeing things all right and hearing me. Okay, great. Looks like we have enough responses here. I think everyone's up and running fine. If you need any assistance, have any issues, just let me know in the chat box and I'll try and help out. Okay, so before we get into the technical analysis on the live charts, real quick, keep in mind, all trades have risk. No one trade is guaranteed to bring you profits. With each trade, there's the risk that you could lose. So you want to manage risk in a way that makes sense, and we go over some ideas in the webinar. So we'll take a look at how our web trader platform today can help you manage risk, so you understand exactly what you're getting into, what the exposure is on your trade, etc. And we have some special tools for managing risk as well, like AvaProtect, which is a unique way to cover risk for a small premium cost for defined periods of time. So we'll go over some ideas in that regard. The other end of that is obviously each and every trade has a good potential for profit as well, which is why we're all here, obviously. So we're going to go over some ideas from a technical analysis standpoint. We'll look at the fundamentals a bit as well, some of the headlines to understand maybe which way the wind is blowing. But we'll go over some technical strategies that might make sense in terms of entry points, exit points for what we see on the charts, and go after those potential profits. Now, keep in mind that what we cover is not meant to be financial advisement, but is coming from an educational perspective. Real quick, for anyone who's new to things, I know a lot of new traders attend the webinars as well as experienced. So we will be on the live charts looking at some nice movements soon. But real quick, what is technical analysis? Basically, it's looking at the historical movements on the chart, usually a candlestick chart, trying to find patterns that maybe lend some predictability to future movements. And so while the history is no guarantee of what will happen in the future, it certainly is helpful with many strategies to find price levels that are maybe more opportunistic for entry points and exit points, and hopefully improve your win percentage as well as you go along. And so we tend to rely on manual methods of technical analysis in the webinars. What I mean by that is, rather than looking at an indicator that tells you when to buy or sell, the manual methods of technical analysis that we go over is more of a learning process where you understand why an indicator is telling you maybe to buy or sell at a certain point, which I think is important. So from the webinar's perspective, you're going to learn maybe what the indicator is looking at, whether you're using Bollinger Bands, RSI, etc. They're all basically doing the same thing that we're going to do manually, which is looking back at the candles, looking for patterns, important price levels, and we'll draw our own lines and make our own decisions. And then later you can add indicators in to support what you already think, to maybe help you on the timing of exactly when you want to buy or sell. If you have any questions, want to give any input as we go along, please use the chat box to do so. I'm happy to address any questions and also share any pertinent information that you might have to share with us. Now, real quick, let's look at the headlines. I said with the technical analysis webinar, but you really can't separate the technical analysis from the fundamental analysis completely. It's nice to know which way's the wind blowing for different instruments, if we can get a feel for that from the headlines, and then go in and do our technical analysis, which is what we'll do. So maybe real quick, 5 minutes on the headlines. Here's one that I thought was important: crude oil higher as OPEC Plus discuss future production levels. And the backdrop of this story has been the same for the past months. Prices on crude oil have been rising as nations have come out of the COVID crisis that's been going on for the past year and a half, 2 years. And so as more demand is there for crude oil, the prices have been going up, as well as all of the inflation of currencies with all the stimulus packages that have been going on through the pandemic. Prices have risen even easier as the demand went up as well at the same time for crude oil. So the story has been, will OPEC adjust their plan and maybe increase production faster than they plan to increase in order to help the average person out and bring the prices down. And it's expected, if you read the articles in this one as well, that the OPEC plus nations aren't so concerned about you and I at the gas pump in terms of the prices that we're paying. They're happy to make a nice profit per barrel, and it looks like they may be planning to stick to their slow, gradual increase in production amounts because they like the prices being high, to put it simple. And if you were selling barrels of oil, you also probably would like the prices to stay high. They have to do a balancing act, though. They don't want to cause a problem where the prices are so high that then folks are outpriced and they stop buying as much gasoline and such. So they need to do a balancing act. But right now it's expected the OPEC plus nations probably are not going to come out in their future meetings here this week, next week, as they go along and just agree to some massive production increases in crude oil. It's not expected they'll do that. Now, maybe they will. And then you'd probably see oil prices plunge. But we see oil prices, as the headline says, going higher in anticipation of what they have to say. And obviously that means they're anticipating that they're not going to announce extra large production increases, which then if they don't increase production so much, then prices will stay up, most likely. Okay, so U.S. manufacturing activity cools, supply bottlenecks easing. Well, that's a positive headline. And we see the markets are kind of mixed today. We've got inflation worries, but at the same time, we've got positive headlines that, hey, maybe the bottleneck is easing. There was a huge supply chain problem, a big problem in the U.S. with not enough truckers. The ports were all backed up. Packages couldn't get unloaded and delivered fast enough. There was all kinds of issues, and they're saying that some of that bottleneck, some of those bottleneck issues are easing. Okay, but at the same time, manufacturing activity cooled. So it's kind of a mixed headline. Manufacturing activity is probably cooling because prices are too high and people can't keep buying things at a faster price increase than what their incomes are rising. So it's kind of mixed today. We see that down here. You can see a quick snapshot of the markets. It's a mix of green and red. US 500 slightly red, Dow Jones largely green, NASDAQ in the red. So it's mixed. We've got a US dollar that is pretty flat, not up much, not down much, and the same with volatility, slightly down right now. It was up slightly earlier today. So the market just doesn't get a feel for which way should it go right now in terms of making a big run in one direction. It seems like that's not happening today. Here's a headline: record 4.5 million Americans quit jobs in November. That at first that sounds negative, right? Wow, 4.5 million Americans quit jobs. Well, there's maybe a silver lining to that. It's because they're applying maybe for jobs that pay better. I mean, usually people don't just quit a job unless there's another job to take. And that's what this article goes on to explain, that people are going after higher paying jobs. And you can understand why, right? With hyperinflation, prices rising so fast, gas costs going through the roof, and groceries and everything else going up faster than people are comfortable with. Well, makes sense. People are quitting low-paying jobs and looking for higher-paying jobs. Now, the question is, will they find them, and how quickly will they find these better-paying jobs, and can businesses afford that? So there's some underlying questions to a headline that is kind of mixed to begin with. And then we look here at some of the announcements that came in. Manufacturing numbers out of Great Britain, higher than expected, again, showing inflation. That's the Purchasing Managers Index. When manufacturers are having to pay higher prices to make things, which is what this is indicating, higher prices than expected even, not just that the prices are increasing, but they increased faster than expected, that's inflation. Okay, so that's feeding into the inflation fears. But then you see the opposite out of the US. PMI numbers slightly lower than expected, but also still high. You know, above 50 shows expansion. So this is in the upper 50s. So that's still showing high demand for manufacturing, but just not as high as it was expected to be. So the economy still looks like it's doing well. There's a lot of demand, which also creates those inflation fears too. And then these numbers are concerning. Maybe the fact that 4.5 million Americans, the headline said, quit jobs, and you see job openings were about 500,000 lower than expected. So there's an undershoot of available jobs, 500,000 lower than expected, and this huge number of people quitting jobs at the same time. So this may put a strain both on those looking for work as well as the employers trying to hire people at a wage that they can afford to pay. And so these are all problems that you get when there's hyperinflation. And that's where some of these worries are coming from. And we keep that in mind maybe if you're trading on something like gold as well, if there's still inflation fears. Okay, so 2 ways that you can trade with AvaTrade, whether you have an MT4 account or an MT5 account, and have our systems help you with your risk management as you do your technical analysis and fundamental analysis. So one way is to use our mobile app. Go to trading platforms, and you can go to AvaTrade Go, which is right over here. Okay, so AvaTrade Go is a mobile app that has all the same features that I'm about to show you on our web trader. So the app is an option for when you're on the move and you're wanting to trade. Has all the features that I'm going to show you that help with risk management, like AvaProtect. If you program take profit and stop loss, as I'll show you on the web trader, it calculates your exposure, your potential profit for you. And so we'll go over that now as we set up some potential trade opportunities as we simulate some strategies. We'll get into the web trader. Now, to get into the web trader, you log in up here. So you click log in, and you'll be here in our web trader platform, which has a similar look and feel to the app. David, good question. Usually the color coding, when you see green, that's referring to increases in price. And when you see red, it's referring to drops in price as prices are going down. But you also could be thinking, if you have an open trade and you're looking at your P&L and it's green, that means you're profiting. And if it's a sell position, it'd be green while it's dropping. And you'd be in the red if it's rising. So it depends if you're talking about these movements here or if you're talking about an open trade. But yeah, usually green means going up and red means going down if we're talking about candlesticks, right? Green candles going up, red candles going down. The P&L and open trades may be a little bit different depending which way you're trading. Okay, so what can we do? Let's look at something that's related to the headlines we looked at maybe and do some technical analysis. We'll keep it simple. How about crude oil? So if we go to oil, we can have Brent crude, we can have US crude, which is just listed as crude oil. We've got heating oil, and we even have futures contracts on some of these commodities as well. Let's do just standard crude oil here and expand the chart. And what we can see as we look at the various candles, this is a one-day candle chart. And you can see that there's been an uptrend for the past weeks. Okay, crude oil dropped, had a big plunge here when there was some fear on the markets. And then for the past several weeks, we can see crude oil climbing back up now in the mid to upper 70s right now. If we want to look at current support and resistance levels. So let me just drag some of my old lines that I drew. And we see on the 1-day candles resistance up here, okay? By resistance, I mean, look at the candles. You see the price hit here and dropped. See the wick came up and it dropped. Then it tried that price again, it hit and really dropped. And now here we are climbing back up and it hasn't reached that price yet, which is right around 79. Okay, so this looks like an uptrend. The headline says, that oil is bullish, it's climbing, OPEC's going to meet. The fundamentals say they're probably not going to come out and try and appease everybody with huge production increases. So likely there could be some continued bullishness based on those fundamentals, at least for the time being. So we see resistance a little ways up from the current price, about $1.80, something like that, to get to 79 a barrel before you'd hit a major resistance on the 1-day candles. Now, what we can do is zoom in on this now and look at, let's say, 2-hour candles. We scroll back a bit and we can see, okay, on the 2-hour candles, we've got a support level down here. And we see it hit and bounced. And now we see it's having trouble right now breaking this resistance here. Let me pull this old line up. So on the 1-day candles, it's out of our view. The line we drew where the resistance is up above our view on the 1-day candles. We drew a line up around 79. Right now we're looking, there's resistance right here at 77.4. Nelson, the percentages that you're seeing in terms of buy, sell, it's showing the recent trading activity for that instrument. Okay, it doesn't mean that's the direction it will go, but it's showing you maybe the trend of what traders are doing. Good question. David, I'm not exactly sure about the investing.com chart with the green and red, whether it's a buy or sell. The candles definitely green are up and red are down typically, but I'm not sure exactly what you're asking about on trade or on investing.com. Okay, so the 2-hour candles then we're looking at it. The oil has found a resistance here. Okay, and there are a couple things you could do with that resistance level. You could sell from it and say, okay, well, volatility is not up big today. It's not down big. There's mixed news. We could catch oil at a high point just before a resistance level and bank on the fact that maybe it's going to keep ranging. Because look at this ranging movement. Up, back down. Resistance, back down. Support, back up. Support, back up. Resistance, the same spot it dropped from here. And here it's at that resistance level. The difference is maybe the fact that the OPEC Plus meeting is soon. Okay. And so let's look at 4-hour candles to get a bigger technical view. And that looks about the same as the 2-hour candles, right? It's testing this resistance level. And so there are a couple things you could do here. You could sell from the resistance, or you could put a pending order up here beyond the resistance. And if it breaks through, buy. And in fact, you could try both of those options. So let's zoom in and look at maybe 15-minute candles and see exactly what it looks like. Here's the resistance. We see hit and drop, hit and drop, hit and drop, and down it went. Now it's testing this price level again. If indeed you were going to sell on this, and let's go ahead and set up a sell position as a simulation. Sell, take profit could be down here near a support level. We'll go to 1-hour candles. You see the support level down here at 74. That might be a bit low. If it's mixed news, maybe if you get a drop, it's only to this old resistance level here, resistance, 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 and then it breaks through and becomes support here. So if you're selling, maybe you're selling for about an 80-cent movement to take profit, let's say at 76.50 as an example. So 76.5. which would give us potential profit of 39. Stop loss would just need to be above these wicks if you think it won't break the resistance, right? So we're talking about maybe 77.80 would get above that, 77.90. And we can play around with that setting a little bit. Stop loss, 77.90. So potential profit, 42, risk, 27.50. So it's a nice balance, right? And you could say, okay, well, maybe we take this all the way up to 78. And we say, okay, we still have a little better potential profit compared to risk. And let's say you're willing to risk 200 on the move. Let's say you had a balance of 20,000, you wanted to risk 1% per trade. So it's very easy. If you go into the trade knowing, okay, 1% of my balance is 200, I can very easily increase my lot size until I see, you see that it's adjusting. As I increase the lot size, my risk, I just keep hitting plus until I see the amount of risk that I want. There's 200 approximately, 202, so 0.23 lots. My potential profit, or I'm sorry, that's my possible profit. So let me keep going. My loss is down here in the stop loss. And so even better, there's my possible loss around 200, my potential profit near 280. Okay, so you see the risk management is calculated for you before you take the trade. Now I go ahead and sell. Okay, so now if we're trading on gold, silver, or FX pairings, we can use AvaProtect as well, along with or in place of our stop loss. AvaProtect, you pay a small premium and it covers any losses during the protected time period. Now, at the same time that we're selling, we also could say, well, you know what? The fundamentals tell us this could keep climbing because of that meeting that's coming up and the expectation that large production increases maybe aren't going to happen. And so the supply issues on oil, demand being high, supply low, could continue to drive the prices up. And the idea of using a buy stop pending order, a pending order that it only buys if it breaks up to a certain price, is you're waiting for confirmation that this resistance here that we drew, this line of resistance where the price hits and keeps dropping, you're waiting for it to break through the resistance level, and then you're convinced maybe that, okay, this should keep going up. So what we do then, if we want to do a pending order, let me minimize this for a second. And we'll go to crude oil, and let's say that we want to do a buy position, but only if it goes above the resistance, right? And since our stop loss on the sell is at 78, we might say, okay, if it hits 78 and 10 cents, breaking beyond the resistance, then instead of selling, then we'll let the buy position open. So you can say buy, but only execute when the price hits and you put the price that makes sense to you. 78.10. So 78, just above $78 per barrel. If it hits that, you buy with this strategy. Okay, you're waiting for a breakthrough of the resistance before you buy. So it has to hit a price up here, slightly above 78, clear of this resistance before you're convinced, yeah, there's enough momentum now, I'll buy. Okay, you're only giving up a small distance to get that confirmation of a broken resistance before you buy. And why are you selling now? Well, because it's below the resistance. And the last several times it hit this price, it dropped. And so you're trying to take advantage from a technical analysis standpoint of an opportunistic spot to sell from. And at the same time, understanding, hey, the fundamentals say this could go the other way. So I'm prepared for that with my pending order. Okay. So the take profit, we saw there was resistance up around 79. So if we put 79 as a take profit, and my stop loss doesn't have to be far away, it only needs to be back down below the resistance, let's say at 77.2, where the price is now. If it broke through and went up to 78.10, if it came back down here to 77.2, then that means it broke back below the broken resistance and was maybe a fake breakthrough. And at that point, then you cut your losses. as an idea for the strategy. So if it came back down then to 77.2, let's say, then we would be out. And now you see, okay, that works out with an equal potential profit to risk. Exactly the same. So you can wait for the breakthrough, have confirmation of an uptrend, and still get your take profit before the next resistance and make as much potential profit as you have to risk with your stop loss. And the stop loss is back well below the broken resistance level with your stop loss down here, okay? Assuming it breaks through and triggers your buy from a higher price. So now you say, okay, I'm willing to risk 200 per move. You know, if you had that 20,000 balance with 1% risk. So here I go. I'm going to increase my trade size until I see the risk that I want. And there it is. I can either go 207 or I can go 198. Let's go slightly under. And so my possible profit 198, my risk 198, pending order all set up, and now I buy. Okay, so both the market sell that we did and the pending order buy makes sense from a technical standpoint. We're selling from below the resistance with an opportunistic location, not having to risk so much to get our stop loss past the resistance, and the take profit with a further distance with a larger take profit than what we're needing to risk. And we see it's trying to pull down now, and it very well could pull down. Our sell could win, and then it goes up and breaks the resistance. Okay, it doesn't always go up and break the first couple times it tries. Even if it's going to break through, it might respect this resistance, pull back a ways, then go up and break through. So we very well could win on the sell, have it then go up, break through, and get activated on the buy. You know, in the best of all worlds, right? With this double move, and hopefully, worst case scenario, if it goes up and breaks through now and the sell position loses, hopefully we win then on the buy. But we'll see. It's doesn't always work out that way, but this is technical analysis. This is what we're using, and we're also keeping in mind the fundamentals. That it's kind of a flat day, not huge volatility. This resistance level might hold. There aren't any OPEC decisions happening right this second necessarily. So the resistance might hold. This could pull back on a day without a lot of huge volatility. And so support and resistance levels might hold. So we're trying to take advantage of that right now with the market sell. So fundamentally and technically, this move aligns. Then we're also considering the fact that from a technical analysis strategy, if the resistance breaks through, then the buy stop makes sense because a broken resistance level confirms upward momentum. And at the same time, fundamentally speaking, we understand why that could happen. OPEC Plus is expected to say, hey, we're not going to rapidly increase production. You know, basically they're saying we like high prices. And so we've got kind of a double move set up here, and we could easily win on both of these moves that we're simulating here on my demo. Now, you obviously can be trading on your live account if you understand the information and like the potential moves. You obviously could go after those moves. Now, what else can we look at then that makes sense with the news that we looked at? And one that I think is obvious is gold. Okay, inflation fears, mixed signals. You know, will interest rates be increased to stave off inflation? That's been, you know, causing gold to shoot down as there's anticipation that interest rates might be increased now this year. The U.S. has indicated they likely will do several interest rate increases in order to strengthen the USD and pull down prices. In other words, to undo the hyperinflation that they've caused with low interest rates. So they're saying, okay, we'll cut back on the bond buying program and we'll increase interest rates to try and slow inflation. The only problem with that, in order to accomplish that, probably that increased interest rate, those steps will cause maybe a sell-off on the stock market temporarily. It could cause Some of the commodities to drop as the US dollar would likely strengthen from those types of moves. And so you could see gold come down. So there's kind of mixed news for gold, fundamentally. It wants to rise because right now there's hyperinflation. Prices are going up like crazy. The US dollar is weak. So that's usually when people buy into gold as a safe haven from inflation. But at the same time, the anticipation of interest rate increases soon and stimulus measures like the bond buying program likely to be pulled back on soon in the US and other places cutting back on stimulus measures maybe as well to stave off inflation. Those fears of that happening sometime soon is actually then counteracting the effect of inflation fears. So those ideas of raising interest rates, cutting back on stimulus causes gold to drop. So it's the opposite of what the inflation fears are causing. So let's look at the chart then on gold, understanding there's mixed news when it comes to gold. Okay, so gold. Let's expand the chart and look at the technical analysis. So these are 4-hour candles. So we see today gold's been climbing. Up, 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 up. That's after a large drop. Why was there a large plunge in gold here? Because the US is talking about increasing interest rates, cutting back on bond buying. So as the price of gold reaches important price levels, then what you're seeing is the sellers then take profit and they sell, and down goes the price. And then the buyers are looking, when it hits their price level, hey, there's still inflation fears, and they buy, and it drives the price back up. So this is actually very good for swing trading, for buying from support levels and selling from resistance levels, because the ups and downs are occurring at predictable locations. So if we then look when there's mixed fundamental news and we say, okay, there are big swings in one direction and then back the other, then we draw our lines. So let's draw a price line here. There's the resistance on the 4-hour candles. Let's draw another price line for support. You see this old resistance here? The wick hit here and dropped, and then it was resistance, and then it kind of crisscrossed across that, and then it became support again here. Okay, this had trouble once it went up, dropping back below this spot, which matches this spot. So that's a price level that many traders might say, okay, if it drops to there, I'll buy. And you see it dropped below, came back, it became resistance, right? Old resistance becomes new resistance. And now it's trying to decide, is it going to go up or back down? It's stuck right on that price level. And the next support level is down here. So you see we're right dead smack in the middle of an important support level down here. Support, up, and old resistance level that was broken here and became support, and then an upper resistance here. So we've got a middle price level that seems to have some importance, and that's right where this movement is stuck. Makes sense that it got stuck here because it's got resistance and support characteristics to it. So this movement is stuck, and we've got upper resistance and lower support. Okay, about $20 down and about $20, let's say $15 up and $15 down to the upper support and the upper resistance. So in this case, you could do pending orders. I have one person saying they can't hear. Give me an okay if everyone's hearing all right still. Okay, looks like maybe it's just Louise who can't hear, so I sent a message. If anyone's having an issue, hopefully, yeah, okay, I see okays coming in, so everyone else must be all right. Okay, so let's zoom in on this price movement and see if we want to make a decision. Do we think it'll go up from this price level, or do we think it'll break back below and go down? So we need to make a decision. What do we think will happen? And so let's zoom in. maybe 15-minute candles. We say, okay, here's gold climbing up. Here's that price level we drew, the old resistance and support. This is the upper resistance and the lower support's down here, okay? So right now it went above that price level, back below. Above that price level, back below. Above that price level, back below. You see that this is an important price level. The market can't decide whether to go above or below that price level. So what do we do in this case? One thing you could do is what we just did with that other pending order, is to say, okay, if it breaks above here, then I buy. And if the movement breaks below here, then I sell. So we need confirmation of which way is this going to go. It's snaking around this old support / resistance level and not making a run either direction right now. So the technical strategy then can be, if it breaks this resistance, then I buy, because then it establishes upward momentum. If it breaks this support, then I sell. So I can say, okay, buy, execute when price hits. If it breaks above 18.1650, so let's say 18.17. If it hits 18.17, I want to buy. Okay, take profit then's up here at 18.29 or 18.30. That's the resistance. So let's say 18.29, just before the resistance up there that we drew. Okay, and the stop loss would only have to be back below this broken resistance. If it breaks above there, our stop loss can be right back below maybe this level and the mid level. So right down here, which would be 18, let's say 13, to get below this important price level here in the middle for the stop loss. 18, let's say 12. Okay, 18.12. Whoops. 18.12. All right, so potential profit 60, risking only 25. So I could even move my stop loss down, let's say below 18.10, 18.09. Whoops. 18.09. Okay, now I'm risking 40, potential profit 60. So my potential profit's 50% higher than what I'm risking still. And I got my stop loss all the way below, not just this price level. I have 1, 2, 3 support levels it would have to break in order to hit my stop loss down here. And still my potential profit is much better. Okay, so I like my stop losses to be below not just 1 support level, but maybe 2 or 3. And look, we have 1, 2, 3 support levels that we've drawn. If we put our stop loss down here at 18.09, it's down here, okay, in this area. And we still have a larger potential profit. So there's my pending order all set up. Now I say, okay, again, I'm willing to risk 1% in my example. You could risk a larger or smaller percentage. That's up to you. But in my example, if I had a balance of 20,000, I wanted to risk 1%. Now I change my trade size up here until I see the risk that I want. Okay, there's risk of 120, 144, 176, 184, 192, and there we are. Quarter of a lot, 0.25. I'm risking exactly 200 with a potential profit of 300. Buy. Okay, now that's a pending order. So if this goes up and breaks this resistance and hits my mark up here, then I'm in on a buy. And I only need it to go to this resistance level, and I take profit. My support levels below me to help protect my buy position from hitting my stop loss, it would have to, after it breaks through, it would have to reverse course and break back below 1, 2, 3 support levels and hit my stop loss down here for me to lose. Okay, now the same thing. What if it breaks, instead of breaking up, what if it breaks down and breaks below the support? Well, then we sell, right? And so entry point below 18.11. So let me minimize this. And let's go to gold and say, okay, sell. Execute when price hits. If it drops below this, let me expand that. If it drops below this support level, that establishes a downtrend. And so let's say if it hits 1811 and a half, or 1811 even, execute if price hits 1811, a sell, okay? Take profit down here just before this support level down here. So let's say, and let's go to larger candles so we can see it better. 2-hour candles. There's the support level we drew at 1797. So let's say at 1798 and a half. 1798.5. Oops. Oh no, I erased it. 1798.5. There we are. Okay. So potential profit larger, or I'm sorry, smaller in this case. Wait a minute. I'm doing this backwards. Sorry, it's a sell. Stop loss should be up here above 1816, so at 1817. Execute if it hits 1811. Stop loss is up here at 1817, above the resistance. Now that makes sense. Okay, so if it breaks the support and executes here at 1811, we're selling and taking profit down here. Take profit is at 1800, just above the support, or 1799, 1798 and a half. Let's go even 800, 1800. And then the stop loss, if it activates the sell by dropping down here, it would have to go back above this price level, this one, and this one to hit our stop loss at 1817. I apologize for the confusion. And now it makes sense. Possible profit, 55. Possible loss, 30. Very, very nice setup with 3 price levels on your side if it breaks below. Now we say, okay, I want to risk 200 in my example, so I need to increase the price, or I'm sorry, the trade size. We can go over 0.3 on this one. And there we are, 198 possible loss, 363 possible profit, and 0.33 lot size. And there we go. So we execute 2 pending orders. Mohammed, you're asking buy limit or sell limit. The nice thing about our web trader and the AvaGo mobile app, you notice I don't have to tell it whether it's a buy limit, a sell limit, a buy stop, or a sell stop on the pending order. All I have to do is pick buy or sell and tell it the price to execute. It will automatically make it the correct pending order. If you want to know, buying from a higher price, the pending order that we said, if it goes up here, then buy, that's a buy stop pending order on the MT4 and MT5. You have to program it as a buy stop. The example of selling, if it breaks to a lower price, that's a sell stop, selling from a lower price. Buy stop on the breakthrough up, sell stop on the breakthrough down. Good question. David, good question. I have a demo account here with almost 100,000, and I'm talking about 20,000 balance. I'm just making up a balance. Maybe it's not realistic for many people to have 100,000 in their account. So I'm talking a number that's maybe more realistic. If it was 5,000, then 1% of 5,000 is 50, right? So if you have 1,000 in your account, 1% is $10. So you have to look at your balance and determine how much do I want to risk per trade. And I'm not saying it has to be 1%. You can risk 10% in a trade if you want. I don't personally recommend that. I think that's a bit risky per trade, but I don't want to hold you back from being more aggressive either. You can be less aggressive, more aggressive with the percent you want to risk per trade. But the point is you should know how much you're risking, okay? You should know how much you're risking. And so the tools on the web trader then help you to know how much you're risking, exactly how I just showed you, okay? all right, I think this is a good place to stop. I don't think that we should carry on over an hour. We've been going 45 minutes. I know many times people start to drop off in terms of attention after 30 or 45 minutes. So I think it's a good place to stop. The strategy that we just used can be carried out not just on oil and gold, but it can be carried out on the major indices, on currency pairings, and pretty much any instrument that you're looking at that you feel like you have a good take on. David, I see you came back. I don't know if you heard my answer to your question. Saw you dropped out and came back. The 20,000 number that I'm saying and the 1% being 200, I'm just making up a number that maybe sounds more realistic for someone rather than 100,000 in the account, which most people don't have. But you could talk about 1% of any number. You can talk about 5% or 10%. It's up to you what amount you'd want to risk per trade. But the point that we're making as we go through these strategies is the web trader platform here calculates the risk for you. So you can be certain of how much are you risking to that price level, to your stop loss, how much you stand to make to the take profit price, etc. As you apply these technical strategies of breakthrough moves to confirm momentum, market moves to go with the news that you know, like we sold on crude oil from just below the resistance. So we've got a mix of market moves and pending orders here. As it worked out, we've got 3 pending orders. We're guaranteed a trade on gold, by the way. We're guaranteed one of them is going to open because it's got to break through up or down. One way or the other, it will break through eventually. So we're in on one of those. And with crude oil, we've already got one going. And then we'll see what happens with the pending order on crude oil and the second pending order on gold, depending on which one opens first. Okay. All right, everybody. Thank you for joining. If anyone has any last questions, now would be a good time before I shut things down. And maybe you take the time to go place some trades now with some of the strategy concepts we went over. All right, I don't see any questions popping up. I think we answered everything that came on the screen. You're very much welcome. Thank you for attending. And until next time, good luck with your trading. I think there'll be some great movements this evening.